Money Made Simple, Episode 2. What is an index fund? Introduction. Welcome back to Money Made Simple. Today, we are covering one of the most important investment concepts you will ever learn, the index fund. If you only ever understand one investment product, make it this one. Because for most people, in most situations, an index fund is all you really need. Chapter 1. What is an index? Before we explain an index fund, let us explain what an index is. A stock market index is simply a list of companies grouped together to represent a part of the market. The most famous is the S&P 500, a list of the 500 largest publicly traded companies in the United States. When you hear people say the market was up today, they usually mean the S&P 500 went up. Other examples include the Dow Jones Industrial Average, 30 large U.S. companies, and the NASDAQ, which is weighted toward technology companies. Chapter 2. What is an index fund? An index fund is an investment fund that simply tracks an index. Instead of a fund manager trying to pick winning stocks, the index fund buys every company in the index in proportion to its size. If Apple makes up 7% of the S&P 500, the fund holds 7% Apple. No guessing, no stock picking, no expert opinions, just own a small piece of everything. This approach is called passive investing because no one is actively deciding what to buy or sell. The fund just follows the index. Chapter 3. Why does passive beat active? Here is the surprising truth. Most professional fund managers, with their teams of analysts and decades of experience, fail to beat a simple index fund over the long term. Study after study confirms this. Over a 15-year period, roughly 90% of actively managed U.S. funds underperform the S&P 500 index. Why? 2 reasons. First, markets are efficient. All publicly known information is already priced in, so finding undervalued stocks consistently is nearly impossible. Second, fees. Active fund managers charge 1 to 2% per year. Index funds charge as little as 0.03%. Over 30 years, that difference in fees alone can cost you hundreds of thousands of dollars. Chapter 4. Index funds versus ETFs. You will often hear index funds and ETFs mentioned together. An ETF, exchange-traded fund, is simply an index fund that trades on the stock exchange like a share. You can buy and sell it throughout the day. A traditional index fund is priced once per day. For most investors, both work fine. ETFs are slightly more flexible. Both give you the same broad diversification at very low cost. Popular examples include Vanguard's VTI, the total U.S. stock market, and SPY, which tracks the S&P 500. Chapter 5. How to get started. Getting started with index funds is simpler than most people think. You need 3 things: a brokerage account, money to invest, and the discipline to leave it alone. Choose a reputable, low-cost broker. Vanguard, Fidelity, and Schwab are trusted options. Select a broad market index fund with low fees. Look for an expense ratio below 0.2%. Set up automatic monthly contributions if you can, and then resist the urge to check it every day. Index fund investing is boring. That is exactly the point. Boring and consistent beats exciting and unpredictable every single time. Key quotes. Don't look for the needle in the haystack, just buy the haystack. John Bogle. The goal of the non-professional should not be to pick winners, neither he nor his helpers can do that, but should rather be to own a cross-section of businesses. Warren Buffett. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. Warren Buffett. How to apply this. 1. If you do not have a brokerage account, research Vanguard, Fidelity, or Schwab this week and open one. It takes about 15 minutes. 2. Look up the expense ratio of any funds you currently own. Anything above 0.5% is worth reconsidering. 3. Search for a total market or S&P 500 index fund in your account and compare it to what you currently hold. The numbers may surprise you. A note at the end. Index funds are not exciting. They will never give you a story to tell at a dinner party about that one stock you bought that went up 500%, but they will quietly, reliably, and almost certainly build you more wealth over a lifetime than almost any other strategy. That is what Money Made Simple is all about. Not the exciting thing, but the thing that actually works.